And even if the economy is kind of slowing down, you're going to see the Fed feel obligated to stay tighter for longer, which risks catastrophe in this kind of an environment, but which is something they may just have to do because if they don't get inflation under control, then we're going to lose faith in the currency. In other words, we're going to assume that the dollar is going to lose value at an accelerating rate going forward, and we'll act accordingly in ways that are very inflationary themselves.
This is Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for August 21st through August 28th, 2023, while supplies last. This week we feature Silver Buffalo Rounds and 10-ounce Silver Asahi Bars, both at just $2.50 over spot. The Silver Buffalo is made by various private mints across the U.S., with the design based on James Earl Fraser's iconic Buffalo nickel. They are highly recognizable and one of the most trusted types of bullion rounds available. These 3/9 fine rounds come 20 to a tube and 500 to a box. And at just $2.50 over spot, they offer unparalleled liquidity at a price lower than many high-volume bars. Next, the Asahi Refinery continues the legacy of famed private mint Johnson Matthey, which they purchased in 2015, and refined with the same attention to detail, cementing their status as an LBMA-certified supplier. Their 10-ounce bars are 3/9 fine and on sale for just $2.50 over spot per ounce. They are also IRA eligible. If you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend John Rubino, the founder of dollarcollapse.com. Now he has rubino.substack.com. So John Rubino from rubino.substack.com. Thank you so much for your time today.
Hey Elijah, good to talk to you again.
Well, great to talk to you. I did want to discuss what is happening in the markets right now. It seems like we have quite a few big players betting against the market. I know Michael Burry released that in June. He was massively short the stock market there. Buffett is buying a whole lot of U.S. Treasuries right now, which kind of maybe signals that we could have a downturn soon. Other billionaires and large players are doing similar things. Your perspective on what we could be heading into in the coming months?
Well, there are a lot of cross currents out there, and I think there are some reasons to be really worried about the state of the economy right now. I'll give you just a couple. One is that credit card debt in the U.S. is soaring. We just broke $1 trillion of credit card debt. And a lot of that is people putting day-to-day necessities onto plastic, which is a really bad thing to do, because that means they're carrying balances month to month that are probably charging them 20% or more per year, which is a recipe for a financial disaster. You go bankrupt quickly when you're paying 20% interest on the money that you need to put food on the table. At the time that's happening, which is bad for consumer spending going forward, obviously, student loan debt is going to have to be paid on going forward. And in October, student loan payments kick back in. They've been in abeyance ever since the beginning of the pandemic in 2020. Some surveys show that there are a lot of people who have student loans who are already becoming increasingly delinquent on their other debts. In other words, even without paying on their student loans, they're getting into financial trouble. Now the student loans are going to kick in, and a lot of people are going to have to decide whether to, pay the rent or pay their loans. And that is also a recipe for lower consumer spending across the economy going forward and a slower growth or a recession. So I think there's a decent chance that we head into a recession or maybe we're already in one. We'll see. Usually the way it works is the economy gets into some trouble, and then the statisticians look back and go, "Oh, okay, on July 17th, that's when the recession started." So it could be that they'll look back on this time and say that we kind of sort of started it now. And that's obviously not good for cyclical investments. So we'll have to see how this plays out. But I think there are a lot of reasons to be very worried right now about virtually anything you've got in your portfolio, because a slowing economy is bad for stocks in general. And there's a lot of cyclical companies that are really richly valued right now. So I think it's completely possible that this is the beginning of a really tough time for people who have broad-based portfolios with a lot of cyclical stuff in there.
Now, it is interesting that we're seeing precious metals rise today as we speak, and we have seen silver at least coming back up. Your perspective on that, do you think that gold and silver could go contra the stock market this time?
Well, gold and silver have had a rough couple of months, and so this could just be a reaction against that. But it's also the case that we're heading into gold and silver's good seasonal time, which is kind of a silly idea when you think about it. Seasonality should not affect stock prices because it's obvious. It's the thing that's right out there, and everybody could front run it, which would kind of short circuit the whole it goes up during this time of year and down during this time of year thing. But it seems to work that way for gold and silver. And the reason for that is that Asian weddings tend to happen in the spring, and Indians and Chinese people especially tend to give gold and silver jewelry as gifts. So that means the jewelers that serve those people have to buy their inventory a little earlier than spring. So it tends to be, in the fall and winter when there's a lot of demand for gold and silver from Asia, which tends to push prices up. Surprised that still works, but it does seem to. And a jump in gold and silver prices during September, for instance, is not unusual at all. In fact, it's kind of normal. So it could be that we're just seeing the beginning of that. Also possible is the idea that if we have an economic slowdown anytime soon here, the central banks of the world are going to have to respond to that pretty aggressively, because we've taken on so much debt that even a modest recession is a potentially existential threat to a lot of over-leveraged financial entities out there. And central banks will want to get ahead of that by easing aggressively as soon as the economy drops into recession. And that's generally good for gold and silver. So it could be that people are kind of front-running the Fed's capitulation out there. Either of those, seasonality and front-running capitulation, are reasonable explanations for gold and silver going up. And we won't know what's true and what's just wishful thinking until after the fact. But right now, I think it seems like a reasonably good time to be in gold and silver and to be adding to positions in precious metals.
Now, I know you have mentioned, speaking of the Fed here, that wage inflation and other factors may actually make it that the Fed cannot reverse and they have to continue to raise rates.
Well, that's the other cross current here. We got the economy that is showing signs of financial stress and maybe slowing down, but at the same time, you've got a lot of power shifting back to unionized workers and to just workers in general right now. And the airlines are a pretty good example of that. American and United just cut deals with their pilots that call for double-digit wage increases for 4 straight years, with them being front-loaded. Big wage increase to begin with, and then further wage increases that average out to 10 or 11% a year. That's a big deal because the Fed tends not to see rising stock, bond, and real estate prices as inflation. In other words, as something it has to lean against, but it watches wages, and rising wages are considered real inflation by the Fed and the other central banks. So they're liable to react to pockets of the economy with double-digit wage increases as something that's dangerous. They've got to lean against them, that they have to raise interest rates even further to counteract. So let the kind of stuff that's happening with the airlines, for instance, right now, spread to the rest of the economy. And even if the economy is kind of slowing down, you're going to see the Fed feel obligated to stay tighter for longer, which risks catastrophe in this kind of an environment, but which is something they may just have to do, because if they don't get inflation under control, then we're going to lose faith in the currency. In other words, we're going to assume that the dollar is going to lose value at an accelerating rate going forward, and we'll act accordingly in ways that are very inflationary themselves. So the Fed knows that it risks losing control of its part of the market if it doesn't stay tighter for longer in the face of high wages. And that's a thing that could happen too. So the short answer to all this is that we've got a lot of cross currents out there, a lot of things happening that point in different directions. And it's not going to be clear until after the fact which ones win out, if any do. And that makes it a tough time to invest, tough time to manage your money, because there are things pointing in one direction and other equally valid things pointing in a different direction. So, the overall theme of investing right now ought to be caution. And as you pointed out before we went live, there are some big high-profile investors who are behaving that way. Michael Burry of Big Short fame just announced a huge bet against the NASDAQ. What was it, $1.9 billion or something like that? It was a really big number.
It was over $1 billion, yeah.
Yeah, so it was a really big number that he's now betting on a decline in tech stocks, which is basically what drives the NASDAQ. So he's saying big tech is going to get whacked pretty soon. And Warren Buffett, as you mentioned, is accumulating a lot of cash. He's buying a lot of treasuries right now. Normally, he does that in anticipation of things getting cheaper at some time in the not too distant future. Both of these guys have credibility. They're not always right. Michael Burry, in particular, has been wrong about a couple of things since his Big Short success. And Warren Buffett isn't always right in the moment. He's taken losses on a lot of his big positions over time, although he's almost always been right in the long run. So those guys doing what they're doing is not an immediate call for everybody else to emulate them, but it is a sign that we ought to be cautious out there, because they tend to be right, or they have been right in the past, about big moves in the economy. And if they're betting on big moves now, those things are at least conceivable. So again, caution. Don't go crazy with any kind of a theme right now. Just diversify and be very careful with your money, I think, is the only way to approach this.
When it comes to one of the biggest investments that people make, their own home, what is your perspective on the real estate market? Because I know you have one view on that. And then also Warren Buffett has been actually long home builders. So if you can expand on your view on the real estate market.
Well, you would think with mortgage rates as high as they are now, they've gone from 2.5% on a 30-year fixed rate mortgage to over 7% now. That effectively doubles the monthly cost of a house financed that way. And that can't be good for the real estate market. And you're seeing existing home sales basically freeze up. It's that measure of housing health is as low as it's been in 20 years. People just are not buying, and they're not selling houses that they own. And that's normally a bad sign for real estate. And you kind of got the same thing going on in commercial real estate, where office buildings are plunging in value right now. So those are usually recessionary signals, because real estate is a big part of the economy. But at the same time, you got Warren Buffett aggressively buying the home builders. Now, his rationale for thinking home builders are going to be okay in an environment where mortgage rates are spiking is that higher mortgage rates are locking existing homeowners into their houses, because if you sell now to take advantage of today's high prices, and you have to go somewhere else and you have to take out a mortgage to do it, that's a very expensive proposition, and people don't really want to get involved in that, I guess. That's why nobody's selling. There's very little inventory of new houses on the market right now. And that leads to the conclusion that if you were a cash buyer, in other words, if you sold a California house recently for a ton of money and you're looking for a new house, it makes sense to just have somebody build it for you, right? So you don't have to get involved in this whole, paying way up to get an existing house to convince some homeowner to sell. And that's good news for the home builders. And they are doing really well operationally right now. They've got full pipelines at acceptable prices. They're reporting good numbers. And in the moment, they're attractive companies because they're doing so well operationally. Now, I think there's another scenario in real estate where a couple of things happen. One is that baby boomers were already supposed to be the demographic doom of the housing market, because as we get older, we tend to downsize, right? If you've got a McMansion that's 4,000 square feet and 3 levels and you're 69 years old, those stairs are no longer fun, and all that upkeep is no longer fun. So you logically want to buy a 1,500 square foot house, get rid of the monstrosity that you're living in now, and be in some place that's one level and it's easy to take care of. That's normal. That's a normal demographic progression for a generation. But it hasn't happened yet, in part because I think a lot of boomers feel locked into their houses by high mortgage rates and high prices for replacement houses. But that can't go on forever because, okay, so you're 60-some years old now, pretty soon you'll be 70-some years old. And then those stairs are going to be that much more of an issue. And so at some point, we are going to see that demographic transition where boomers start selling their houses and a lot more inventory comes onto the market. The other thing is Airbnb renters now, because you've got a lot of people who've bought 10, 20, 30 Airbnb properties and they're renting them out. And it's a pretty good market right now. But in an economic downturn, it will not be such a good market because people won't travel as much and they won't want to pay as much as they do now when they do travel. So you'll see trouble in the Airbnb market, which will lead a lot of people to have to sell some of their inventory, which will increase the number of houses that are for sale out there. You see those two things happen, and all of a sudden, this shortage of houses for sale will turn into a glut, and prices will fall for existing houses, and that's going to be bad for the home builders. If you look at the charts of the home builder stocks, in the 2007 to 2010 era, when there was another housing crisis, you see their prices plunge because people were looking at all the bargains that they had from the repossessed houses out there and not really that interested in buying or building new houses. So we could see a return to that kind of a market in the not too distant future, where a shortage becomes a glut and the home builders just see their business dry up. So I think there's a case to be made for shorting the home builders at these current high prices in anticipation of something like that. Now, we don't know how that's going to turn out, but I think the case can be made that the home builders are interesting shorts right now, even though their operating earnings and their share prices are doing really well in the moment. So we'll see. It's one of those things where there are two sides to the story. One side is going to be right, and we don't know which one for sure, but we're going to see it play out in the next couple of years, and we'll find out. So I personally am short some of the home builders, and I don't like being on the other side of a Warren Buffett trade, but I'm going to stay with my short strategy for now, just on the assumption that the demographic thing and the Airbnb thing plays out and changes this market in the not too distant future.
It seems like we could see a changing market, and some people think very rapidly if we continue to see, if we see a downturn, for example, in the stock market and the economy. A lot of people are concerned about the banks as well. In your article about wage inflation, you mentioned how if the Fed continues to if the Fed continues to raise rates, then that is just going to put more pressure on banks and pension funds and all of that there. Can you expand on that?
Well, yeah, financial institutions, like you said, banks, pension funds, insurance companies own a lot of bonds, and they have a lot of real estate exposure of various kinds. Those two things are interest rate sensitive. And if you have the Fed raising interest rates aggressively because they're terrified of what's going to happen if wage growth kind of spreads at 10 or 12% a year, then that's going to hurt bond prices. When interest rates go up, that's the same thing as saying bond prices go down. So the bonds on the portfolios of financial institutions develop embedded capital losses, which at some point have to be reported. In other words, so these big institutions have to show losses from their bond portfolios, and it makes real estate prices go down eventually when interest rates go up. So you'll see losses being reported by banks and insurance companies and pension funds, which will scare the people who have money invested with those entities and cause them to pull their money out or do other things that hurt institutions like that. And so you'll see a lot of those guys reporting bad numbers, seeing their stock prices fall, seeing money be pulled out, and you'll see runs on them in various ways. That's a recipe for a financial crisis that leads to a really dramatic recession too. We saw something like that back in the housing bubble and bust of 2005 to 2010. And that was brutal for financial institutions. You saw a lot of banks just collapse. A lot of insurance companies saw their derivatives books, of all things, blow up and had to be bailed out. So the same thing could happen this time around if interest rates go up too far, too fast from here. And if wages keep soaring like this, there's a decent chance that interest rates are going to do just that. So that's the one of the financial crisis scenarios that are out there right now, and that's a very real possibility.
I think, as we've talked about before, a lot of people are concerned about their money in the bank. That's one of the things that people who call to purchase precious metals are very concerned about. The dollars that they have in the bank, and they want to get it out of the bank, out of the bank's hands. What is your perspective on that? Because I've heard multiple things. People saying, don't have pretty much any money in the bank just for your daily expenses. Have only those funds. And other people are saying, well, there's the FDIC insurance, so just have below that, or have it in a too big to fail bank. Then you're completely protected in theory. Your perspective on the banking system and how it stands right now, and what people should be concerned about there.
Yeah, well, what you just described is the debate that's going on out there, and basically, the impulse is that if your bank gets into trouble, or a bank similar to your bank gets into trouble, you don't want to be there when there's a run and a bailout and everything. It's just easier and simpler and more restful to take some of your money out and put it somewhere else. So the question is, where does it go? Because we're going to see stuff like that more in the Silicon Valley Bank vein going forward, where banks have to report that they're losing money in their real estate and their bond portfolios. That scares depositors who pull money out, which causes the bank to have to sell some of their bonds at a real loss in order to pay off the depositors, and then the run gets worse, et cetera, et cetera. You don't want to be involved in that. So your impulse will be to take money out of your bank. Where do you put it then? And so here's the scenario in which gold and silver do not get whacked this time in a financial crisis, because normally they go down along with stocks and real estate prices for a while, and then rocket back up when the Fed capitulates and starts easing like crazy. This time, it's possible that the money flowing out of regional and local banks flows in part into precious metals, because people are looking for safe places to put their money, and their bank is no longer safe. So one of the places that you do go when even your bank can't be trusted is gold and silver coins. So it could be that there's a rise in demand for gold and silver that cushions the effects of a recession on precious metals prices, and that gold and silver actually do just fine in the coming recession. I think it's possible. Again, we'll only know in retrospect which of these scenarios play out. So it's possible that they get smashed again, gold and silver, like in 2008 and in 2020, when stocks went down and it pulled everything else down with them. Or it's possible that stocks are hurt by a slowing economy, coupled with a banking crisis, and precious metals actually benefit from the banking crisis part of this, and they hold up. I don't know. We'll see. I don't think you should be bailing out of precious metals right now. You want to stay with your core holdings in gold and silver through everything until gold is $10,000 an ounce and silver is $200 an ounce. Your core precious metals should stay your core until this whole thing plays out and reaches its endpoint of a giant monetary reset. But with, for instance, your gold and silver mining stocks and the gold and silver coins you have that aren't part of your core portfolio, then you might want to, kind of think about how you want to play a slowing economy and a banking crisis, et cetera, et cetera. You might actually even want to buy more gold and silver in anticipation. It's just a question of which scenario you think is more likely. And I have all the gold and silver bullion that I need for this lifetime, I think. But I'm still buying really high quality miners right now, because I think some of them are just operationally so successful that they're liable to do well, or they're liable to attract a big buyout, regardless of what the overall market is like. So you can still, convince yourself that certain sectors of the precious metals market are interesting. And if you don't have enough gold and silver bullion, in other words, if you're stacking, but you've got an objective out there in the future of much more, then you should keep stacking. Just do dollar cost averaging, buy a little bit at a time, say the same dollar amount each month, for instance. And if the prices of those things go down, then that's fine. You get more ounces for the same amount of dollars each month. And then eventually when they go back up, you'll have a good average price. So don't be freaked out by any of the gloom and doom that you hear from people like me, and stay with your plans, but also don't be really aggressive in any one direction, because you just don't know which direction things are going to go.
Yeah, I think a conservative approach is definitely good. And I mean, I feel like you can't get more conservative than actually holding your wealth in your hand. I mean, that's what people have been doing throughout history. Real money is a fantastic way to prepare, I think. Any last thoughts, John, before we let you go? And where can our viewers find you online?
Well, I'm at rubino.substack.com, and what I mostly focus on there is actionable stuff, like we've been talking about. So which exactly are the best uranium stocks? Which gold and silver miners do you want to invest in? Things like that. And I really do think that this is a fascinating time in financial history, because you got so many really big things happening, and we haven't talked about the BRICS countries meeting. As we're speaking right now, the BRICS countries are having a meeting in South Africa, where some of them have intimated that they might be talking about introducing a gold and silver backed currency, or a gold backed currency. And other attendees have said, no, that's not on the agenda. So it'll be interesting to see what part of that story actually turns out to be true. And right now they are talking about de-dollarization a lot. In other words, they're talking about how to trade among themselves without using dollars. And that's a very big, very important trade, because the BRICS countries and the other countries who want to join that coalition, including Saudi Arabia, by the way, have a lot of financial power, and they control a lot of commodities. So if they're going to accelerate the process of getting away from the dollar, using their own currencies, however we define their currencies going forward, then that's a big financial trend that we need to be paying attention to. So we'll know in the next couple of days exactly, or we'll know by the end of this week exactly what it is they're thinking about doing going forward, and that's worth watching.
I think it definitely is. We'll keep an eye on that, and definitely have to have you back on once we know all of what has happened this week. We do appreciate your time, John, as always. We'll put a link in the description right there. You'll be able to see it if you're watching the video here. Rubino.substack.com to all your work. Once again, thank you so much for your time, John, and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.